$600 billion gone in 13 days. SpaceX just had the biggest IPO ever, and it's already crashing. So I ran the real numbers, and what I found is messier than anyone arguing about this online wants to admit. Here's why this matters even if you don't own a share of it. When a company this size goes public, it doesn't just move its own stock, it drags the whole market's mood with it. SpaceX priced at $135 a share on June 11th. Closed day one at $160.95. 4 days later, $225.64, all-time high. Then it gave almost all of it back. So which number was real, the hype price or the price right now? That's not a vibe question, that's a math question. Everyone's take on this is the same. Huge IPO, huge hype, huge crash, bubble, case closed. Fair. Retail really did pile in. Real fear of missing out on the biggest IPO ever. But it spiked, then it dumped isn't an analysis. It's a chart. It tells you what happened, not what the business is actually worth right now. So let's look under the hood. Revenue, $18.67 billion, up 33.2%. Real growth. Net loss, almost $5 billion. Free cash flow, negative nearly $14 billion. Real bleeding, too. Now, the number everyone actually wants. Fair value. Invyra's composite model, $211.94. Trading at $156.11. That's a 26.3% discount. Undervalued. But Invyra flags that number low confidence. And here's why that actually matters. Strip out the relative value methods. Run pure discounted cash flow, the one model that forecasts the business instead of comparing it to other stocks. That number says $44.81, overvalued by 248%. Same company, same day, two models, two completely different stories. So which one's right? Honestly, neither one alone. That's the entire point of running it through more than one lens, instead of picking the chart that confirms what you already believed. Here's the part that actually worries me more than any of that. Return on capital, negative 7.7%. Cost of capital, 10.7%. Every dollar they spend right now is destroying value, not building it. Financial health check, 1 out of 4 passed. Moat, narrow, 6.8 out of 10. Real edge in reusable rockets and Starlink's satellite network. But Amazon's Kuiper and Blue Origin aren't sitting still. And smart money, institutions, insiders, neutral. Nobody's all in. Nobody's running for the exits either. Here's the twist though. Earnings quality, A+. The losses are real, not accounting tricks. The cash backs it up. Capital allocation, a C, mostly because of how much debt they're carrying. So this isn't a company faking its numbers. It's a company spending fast, financing a lot of it with debt, while analysts keep raising revenue estimates. Up 62% looking forward. And just to raise the stakes further, they signed a $60 billion deal to acquire an AI coding company, raised $25 billion in their first bond sale, with $89 billion in demand. This thing keeps getting bigger and more complicated by the week. Put it all together, Invyra's own signal lands on hold. 6.4 out of 10, low conviction. And that matches what I'm seeing. Real business, real growth. But right now, destroying value on every dollar invested, a stretched balance sheet, and the one model with the longest track record saying the price is way ahead of itself. I'm watching 2 dates. August 6th, first earnings as a public company. And whenever the lockup expires, when a lot more stock hits the market at once. Until then, the gap between price and fair value is the story, not the rockets. Run this same breakdown on any stock you're holding. Invyra, free for now, no credit card. Follow for more latest information.